Welcome to Retirement Decoded with your host, Scott Tucker, where we break down the complexities of retirement planning to give you clear, actionable advice. Whether you're just starting out or getting ready to retire, Scott's here to help you make informed decisions and secure your financial future. Tune in each week as we simplify the process and decode the path to a stress-free retirement. Now, here's your host, Scott Tucker.
Welcome back to the Retirement Decoded podcast with Scott Tucker. I'm your host, Scott Tucker. Of course, on microphone number 2 is Associate Advisor Andre Hootie. Say hello, Andre Hootie.
Hello, Andre Hootie.
Andre Hootie, the podcast has been, it's been catching on.
Yeah, it
I'm
has.
sure there's some people don't like it.
I mean, there's people don't like all of things. You can't
always,
make everybody happy.
Always some haters.
Always.
Here's somebody who doesn't hate us. Marie writes to the podcast. Marie says, Scott, when rebalancing, it is said to look at all accounts in aggregate to reset back to the target allocations. Well, I don't agree with that, Marie.
Yeah.
Why not, Andre?
Because it doesn't always have to go back to the target allocations.
Well, but I'm going to reread the way Marie says this. When rebalancing, it is said to look at all accounts in aggregate and reset back to target allocations. What do you hear there that you don't like?
Well, I guess it depends on what kind of accounts we're going to be
There you
with.
go. There you go.
Okay, you stumped me with that one for a second.
Stump the chump. So Marie, the thing is with your non-qualified accounts, like some people call them brokerage accounts, but non-qualified accounts, if you just go rebalancing without considering taxes, then you could really get in trouble, couldn't you?
Yeah. You have to be careful. Those non-qualified accounts can be very tricky.
Now, at the same time, Marie, if you have some winners and some losers, we could pair those together and perform tax loss harvesting. You might be able to avoid taxes as you rebalance. And so, Andre, really on the non-qualified accounts, the non-IRA, the non-Roth, those kind of accounts are where we can incur some taxes, and we have to be careful.
Yeah, because it's not like IRAs, not like Roths and traditional IRAs where you can sell in there as much as you want, no tax consequences. It's and then it's only tax consequences if you pull money out. It's not the same in a non-qualified. In a non-qualified, it's as soon as you sell, that is the taxable event. Whether it was a gain or a loss, it's going to be reported in the year that you created that sale.
At the same time, you don't want to just sell your losers and not pair them up with sales of winners, potentially, because you want to take advantage. You want to take advantage of the tax loss harvesting. If you're going to get some tax losses, you want to pair them up with taxable gains.
Yeah, and you should be aware of that there are limitations to how much you can claim in a given year. So you want to be smart because you may have losses that you might not be able to claim this year. So you have to know the rules about that.
Well, you could pair up the losses with the gains. But then you're saying, like we had somebody we talked to recently that they had a $30,000. They had a mutual fund that did nothing but lose money.
Yeah,
they had a $30,000 tax loss they could take, but they didn't have any gains to pair it up with.
Exactly.
So they would be able, and this is not tax advice, they would be able to make that trade, and then they could claim $3,000 tax loss for about the next 10 years.
Right.
But if you could pair up the loss with the gain, then you could do a tax loss harvesting. Those could wash.
Yeah, in that same year. Yeah.
Yeah. And then Marie continues. And Andre, everybody who writes the podcast, they always continue. That was just her first sentence. It's fine, Marie. We're just picking on you.
I appreciate the detail.
She says, however, pre and post tax accounts have different jobs to do. I don't agree with that, but I think refer to our answer to sentence number 1. She says, I don't need access to the pre-tax money for a long time. Now, Andre, the problem there, she's saying the pre-tax money, so she means her traditional IRA or traditional 401k. She's not quite, I guess she's saying traditional IRAs most likely. Yeah. I don't need access to the pre-tax money for a long time, which would suggest to be more aggressive here and be more conservative in after-tax accounts. There's a whole mess there.
Mm-hmm.
She doesn't need access to her traditional IRA money for a long time. That's no reason to not consider things like Roth conversions. That's a whole nother tax planning conversation, which would suggest to be more aggressive here, I guess in traditional IRA. Really, your risk appetite should not vary between IRA, Roth, or non-qualified. I think it ought to match. And then she says, and be more conservative in what she calls after-tax accounts. These are not, she's talking about non-qualified accounts, Andre, right?
Mm-hmm.
So to be more conservative in non-qualified accounts. Non-qualified accounts are not after-tax accounts. Everybody calls them after-tax accounts or brokerage accounts. But you've paid this is your non-qualified account was funded with take-home money, we could say. And it doesn't mean it's after tax. You could actually make a bunch of money in there, a non-qualified account, and have all kinds of taxes.
Yeah.
Short-term capital gains, long-term capital gains. Now, while we're on the topic, short-term capital gains, you could be in the ordinary income tax brackets, or the long-term capital gains. If you hold something for 12 months in a day, then you could be in the lower, the better treatment, long-term capital gains.
Yep.
A lot of people miss that too.
Yeah, that's not something that it's openly told to anybody, whether it be your broker or anybody. That's most people can't give tax advice. So where are you really going to find that info? Yeah,
the amount of things that aren't taught in school is endless, isn't it?
Yeah, it's and quite frankly, conspiracy theory or not, I think some of this is done purposely.
Public schools were called for in the Communist Manifesto in 1848, and they were as a means to make workers for industry, not to make industrial workers wealthy.
I think we've seen that in the United States.
Dumber and dumber every year. Well, there's a reason. So we are talking to you from Chicago, Illinois. We are federally licensed, so we can help Americans all across the country and in territories and all that stuff. But in Illinois, as you know, Andre, in school here in Illinois, there's no requirement to take a government class or a civics class to graduate high school.
Yeah, which is just crazy to me.
It's also on purpose.
Yeah, it's our future leaders, right? If you don't teach them, they can't do it.
Now, Andre, you went to school here in Downers Grove, Illinois, near the Scott Tucker Solutions Studios. And so when you went to school, they didn't require government or civics or whatnot to graduate high school. Mm-hmm. And we've talked about in Illinois changing that law for a long, long time. Our government in Illinois is one-party control, and it's been like they've refused to add a government or civics class to high school.
Oh, because if we knew how it was supposed to run, we'd be angry that it's not running.
I sometimes talk to people who went to school. I know you're smarter than the average bear, but sometimes I talk to somebody who grew up here in Illinois, and they don't know very basic things about how the government works, which is kind of weird. I grew up in Michigan. In Michigan, they have a state law. You cannot graduate high school without taking a government class. And
I think that's rightfully so. You should at least know a little bit about the municipality you're living in or the country you're living in. It's just on a broad basis.
Well, we have people, and it can happen in Michigan, too. It's not like the smartest people in the world are in Michigan are the most educated. But there are people that don't understand even simple things. Like, remember that cartoon, how a bill becomes a law or whatever it was? I'm just a bill, whatever. But there are Americans all across the fruited plain. There are Americans that don't understand what can happen. Like in Illinois, we have supermajorities, meaning 2/3 control of our state house and our state senate by one party. And this is crazy in Springfield, in Illinois, the state house and state senate, they can actually override a governor's veto. So they can pass law by themselves.
That's
even though it's all one party control right now.
Right.
If you have two thirds in the House and 2/3 in the Senate, and they can just override in both chambers, they can override the governor's vetoes.
Well, I guess that's pretty similar to if you look at how the judicial and electoral government is those.
What are you talking about?
So if look at any Congress and Senate, right? So it's not just a state specific thing. Even if the president vetoes, same sort of thing, right? I believe it's a 2/3 majority.
Yeah, it is. But no, what I'm saying in Illinois, right now there's been that's a whole long story. The one party has control of the remap. So every 10 years when there's a census, one party. It's kind of a crazy system. In Illinois, every 10 years when there's a census, the party that's in control gets to write the map. It determines how you can gerrymander the U.S. House districts. Yeah, so anyway, that's a whole long story. But there's a lot of dangers of having a single party rule. At the federal level, we don't usually have single party rule. Usually when we do, things can get a little hinky. And then she says, so Marie said, I don't have access to the pre-tax money for a long time. I don't need access to the pre-tax money for a long time. We ought to be thinking about tax planning for retirement, Marie. So if you have a lot of money, what's a lot? Just doesn't need to be a lot. If you have money in traditional IRA, that's going to be federally taxable at some point. In Illinois residents do not pay taxes on retirement accounts, but we have clients all across the country, like Wisconsin, Michigan, and such, where they pay tax on their IRA. So we should probably talk about that. If you want to get on our phone calendar, Marie, just go to tuckerretirement.com. At tuckerretirement.com, you can see our phone calendar, and you can schedule yourself right there. We'll spend 15 minutes with you for free in the coming week over the phone and get your questions answered and your answers question. So she said, she said that part. She said, which would suggest to be more aggressive here in traditional IRA and more conservative in my non-qualified accounts. And I don't think you want to have a high volume of trading in your non-qualified accounts.
Exactly, yeah. And here's kind of my take. I agree with you 100%. I don't think you need to have different risk levels across your accounts. You should just do overall planning and then plan all your accounts around your general planning, not plan for a specific
around your risk appetite.
Exactly.
But we probably we've seen clients get in trouble before where they come to us and they say, "Why am I paying $20,000 a year in taxes on my non-qualified account?" So one way people run into that is they put something that's not tax efficient, like a mutual fund that pays dividends, or it could have kind of like unrealized gains. If I'm thinking, how am I thinking of that? There can be people buying and selling in a mutual fund that you're in, and you have that mutual fund inside a non-qualified account. You could make no changes. You could even receive no income.
Yeah,
that's an even better example. You could have some volatility in the market, and you have a mutual fund inside a non-qualified account, and different folks for different reasons are cashing out, they're redeeming shares, and it could, on paper, create a gain for all of the mutual owners of that mutual fund, and it could cause taxes that you would then owe to the federal and state government.
Yeah, even though you didn't receive anything.
You didn't do anything. You could actually, you could receive no money, and you could get a tax bill for like $20,000.
And people don't know that. And mutual funds are one of the most popular vehicles out there. And anybody that does it yourself, most of the time we see they're investing in those mutual funds, and they cause that sort of issue all the time.
Within the last 12 months, we've had 2 different people come to us saying, "Why am I paying $20,000 in taxes and I'm receiving no money?"
Yeah, which is
from a mutual fund inside a non-qualified account.
Yeah, and it's funny. In both those scenarios, we guessed that ahead of time. We didn't even have to look at the statement. I mean, we reviewed and everything and showed them where it was, but we knew ahead of time. But they had, it's not something that's just relevant or prevalent. That's
what's sad too, is that we know where to look, but people don't know how to avoid the mistake. Mm-hmm. In both cases, very smart people, but people trying to do everything themselves, and it's kind of like I could build a house myself, but I probably shouldn't. I don't want it to collapse on me.
Mm-hmm. Yeah, exactly. You should do this once or twice, before you go full swing, practice wise.
Well, I think if you don't do, one lady that we saw had the situation happening. She's actually an accountant, and she made this mistake. Mm-hmm. Another gentleman, pretty smart cookie, and self-employed, and he built up a business, sold it for a bunch of money. Pretty smart guy, and he made the same mistake as well. Then Marie says, "Scott, what other questions should I be asking myself?" That's the problem, Marie. And you're doing it all yourself. You got to ask yourself. Mm-hmm. Say, Andre, when you sat down with yourself and you asked yourself, what did you recommend? Marie says, "Scott, what other questions should I be asking myself to determine to rebalancing using all accounts or separately by tax treatment?" I think we've already answered that. Wow. A lot of stuff there, Andre.
Yeah. And, Marie, here's my last idea. And again, I think you should always kind of set a whole risk number for yourself. But if you're going to really determine one account's going to be riskier than the other, you shouldn't be riskier in your Roth IRA or in your IRA, right? That's money you can't necessarily write off. That's money you want to grow tax-free for a long time. And you want to have more stability in that, because that's the best tax treatment you're going to get in those Roth IRAs. If you're gonna, if
you almost, we got to clean that up. You almost said, you didn't mean to say this. You said tax-free after you mentioned traditional IRA.
Right. Yeah. No. So yeah, I should clarify that. So the Roth IRA is going to be tax-free. So that's the one you want to have more consistency, and you want to let that grow. You don't want to give a lot back to the market. So, you want to make sure your risk is appropriate for you. But, again, if you're going to split it between accounts, if you're going to be riskier in one versus the other, I mean, a non-qualified account would be the only one that you can actually take tax write off some tax losses on your investments against your taxes.
Andre, I'm going to disagree. We ought to have a risk assessment or risk appetite over all our accounts.
I agree with you there.
Let's not go backsliding.
I mean, we tell this to people all the time, but they go and do what they want,
Well, you're trying to confuse people now, aren't you? You're going back over stuff we already said. I think that the tax, we can rule out any of the tax ramifications of trading within the IRA and the Roth. We do want to highlight that your IRA is tax deferred, not tax free, and you're going to have to pay the piper eventually. So we might want to talk about some tax planning for retirement and do that now, not when you're retired. Andre, all the time we say people ought to do their tax planning for retirement and say, okay, good, I don't retire the next year. Like, no. You gotta come on.
This is you should do this a couple years in advance at least.
10 years or right away.
5.
Well,
5
no,
is a
now.
minimum.
No, now when we're talking about Roth conversions, should we wait? Should we wait any amount of time to look at those?
No, you really shouldn't. I mean, unless you're before age 59 and a half, there's some hiccups there. But yeah, no, Roth conversions you can do whenever you want. You just have to.
Yeah, so don't run out and do them, Marie. Don't try this at home. Talk to us first. Go to tuckerretirement.com. Get on our phone calendar. Andre, you're stepping on my toes. So what I was getting at is when I have a friend actually who's a Chicago public school teacher. And I said, he wants to move out of state. And I said, before you do that, read this book. And he goes, well, okay, I don't retire till next year. No, you got to read the book now. And we have to do tax planning now. Now, so I even would say if you're 40 years old, if you're 30 years old, if you got a bunch of money in traditional IRA, we got to be talking about tax planning for retirement, not putting it off. And we should have one risk appetite across all of our accounts. The only one we have to be careful with as far as trading or rebalancing, Marie, is in the non-qualified account. But just because you have traditional that you don't need for a while doesn't mean we just leave it alone or we wait until 5 years before you retire or any of the rest of that. This is Retirement Decoded with Scott Tucker. I'm your host, Scott Tucker. Welcome to the podcast. If you could give us a good review, give us 5 stars, share it with a friend on Facebook page, that'd be great. Also, don't forget, you can go to tuckerretirement.com, get on our phone calendar, and we'll see you on the next episode.
Scott Tucker Solutions, Inc. has a strategic partnership with tax professionals and attorneys who can provide tax and/or legal advice. Neither the firm nor its agents or representatives may give tax or legal advice. Individuals should consult with a qualified professional for guidance before making any purchasing decisions. A Roth conversion is a taxable event and may have several tax-related consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA. The views and opinions herein are those of Scott Tucker Solutions, Inc. and do not necessarily reflect the views and opinions of AE Wealth Management, LLC. Investment advisory services made available through AE Wealth Management, LLC. AEWM and Scott Tucker Solutions, Inc. are not affiliated companies. Insurance products are offered through the insurance business Scott Tucker Solutions, Inc. Scott Tucker Solutions, Inc. is an investment advisory practice that offers products and services through AE Wealth Management, LLC, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by Scott Tucker Solutions, Inc. are not subject to investment advisor requirements. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying ability of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Scott Tucker Solutions, Inc. is not permitted to offer, and no statement made during this podcast shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Scott Tucker Solutions, Inc.